welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast. And I'm one of your hosts, AJ Wheeler. With me, as always, is Mark Pallardy.
Hey, everyone.
Got a great show for you. This week, we talk about 6 nonprofit financial best practices. So we talk everything about credit, budgets. We've probably discussed it before, but it's worth going into again. And one thing that we haven't touched on before is probably credit for your nonprofit. So we'll get into how to use your credit, what you need to use, what you need to get credit, and some pitfalls that we've seen in our practice over the years. And then we have another article on cryptocurrencies, but this one's about decentralized autonomous organizations, DAOs, what they are, what you need to know about them, and our advice on if you're accepting crypto or stock donations. We'll get into that. And then we revisit a topic we did a while back called fair accounting. Our first voyeur into this was actually, kind of laying out why fair accounting or the environmental accounting, as it's sometimes referred to, isn't a good idea, and how trying to quantify this stuff is really difficult. Well, this is actually a response to that article from the very people that we were criticizing, and their response to our first article. So go back and listen to that one if you want, but we'll get into what fair accounting is and how we think it's a little bit difficult to value this stuff, but we'll talk about it. And then our topic of the week are what are membership dues and what are donations, and how can you tell the difference? And do you need to call them by the correct name? We'll get into all that, and we'll discuss what makes up a membership versus a donation to your organization. So anyway, Mark, I think you got our first article for it. Take it away.
Yeah, thanks, AJ. This article is from Nonprofit Hub. Katie Appold writes an article, 6 Nonprofit Financial Best Practices. So we cover a lot of these kind of top, et cetera, ways of doing things. But I thought this one was a little bit different because it actually goes a little deeper into some financial practices that I think are beneficial for both for-profit and nonprofit. But obviously here, we're focused more on the nonprofit angle. So let's get into this. The article talks about financial best practices that add security and longevity to your nonprofit's mission. So point number 1, build credit for your nonprofit. And this is good for any business, but starting out, you want to be able to, if you're new starting out nonprofit, you want to start, trying to obtain credit cards and building yourself a reputation as somebody who is able to manage credit and gets a, credit rating if possible. So you're able to manage the credit. You might get yourself one of those, DUNS numbers so that you can actually use that, because that's going to be on a lot of applications. If you want to do, billing where you want to have people, you don't want to have to pay everything immediately by credit card or cash, and you want to be able to, have a net 30 with some vendors, you're going to need to build some credit. So building your credit, something you don't often think about in a nonprofit world, but you are going to be spending money, build that credit. Number 2, compare financial reports to your budget. This seems like an obvious one for accountants, but I have gone to a lot of nonprofits that don't run a budget to actual every month or even every quarter to look and see how they're doing and to assess what's going on, where they hit things right, what metrics are off. So I think comparing your financials to your budget and running one of those, looking at your variances, coming up with explanations. And explanations could just be as simple as, it's just a timing issue, or it could be we way over budgeted or under budgeted for this expense. So, or revenue for that matter. So number 3, diversify your nonprofit's funding. So this one's a little tricky, but this talks about kind of coming up with multiple channels for revenue coming into your nonprofit. That could be as simple as, having fundraisers, having grants, having individual donations, et cetera. But, they also talk in here about doing things like having rental income or, getting fees for other services. AJ and I were the consummate preachers for UBIT, right? So you want to be careful that whatever revenue you're bringing in, if it's not related, it could be subject to tax. So just have that awareness when you're going in, but definitely diversifying your funding is a good idea. Be prepared for non-cash support. Okay, so you can tell we're on a little bit of a bender these past few weeks, and it'll continue after this article, but you got to be prepared for other types of revenue that are going to come in. So the most common type that has been around is stocks, right? If somebody wants to give you some stock gifts, you have to have a brokerage account of some sort to be able to receive those stock gifts. And then our recommendation usually is to liquidate that right into cash, so you're not having to manage a stock portfolio. But the same holds true for cryptocurrencies. So that's the buzzword. But you want to be prepared. If somebody wants to give you $5 million in cryptocurrency, who are you to say no? But if they want to make that exchange immediately, you got to be prepared for that. So be prepared for all that non-cash support that's coming your way. Also, number 5 is use a fundraising plan. So you want to create a plan, create a budget. I don't think we need to say much more on this. We've talked about that ad nauseum. And then create an operating reserve. An operating reserve, that's going to look different. We've again touched on this a number of times. That's going to look different for each organization. Oftentimes you want to have minimum of 3 months of operating income. We've seen with the pandemic and that sort of stuff, 3 months wasn't even enough for a lot of people. We even had federal support programs, but a lot of nonprofits disappeared during COVID. So make sure you have a reserve to cover yourself. You don't want to have such a heavy reserve that people are thinking you're just stashing cash and not actually providing services based on your mission. But creating an operating reserve is always a good idea. AJ, some of your thoughts?
Yeah, I thought it was a good article because it's something I don't think that a lot of nonprofits think about or that we've discussed on the show before. But having some kind of credit, built up for your organization can make a huge difference. I work with a lot of organizations that work on like a cost reimbursement kind of situation where you must expend the funds first and then you get reimbursed afterwards. You're invoicing for money spent on, payroll and supplies and time and mileage and all that kind of stuff. So to be able to have, what that means is you're spending money, bringing your cash balance down before you're getting it back in. And a lot of those cost reimbursement grants happen through government agencies, and they're notoriously picky about what you send into them, how long it takes for them to process those payments. So having an available line of credit or credit cards to, delay the payment of expenses and such is vital. And I think it's something that a lot of young nonprofits don't think about. They're, kind of money in, money out on kind of like a cash basis is kind of how they operate. So being able to build that up, I mean, I've seen the small nonprofit that I work with that's built themselves into a pretty decently sized, mental health organization. They started with nothing. It was very difficult to get credit for that. So they started small with like a credit card. It can even be a secured credit card. And the reason why it's usually traditionally hard for nonprofits to access credit is because it's, there's no owner to fall back on. So there's no personal guarantee. Usually banks like a personal guarantee when they're delivering new lines of credit or credit. So I've seen in the past where board members actually, put their name on as the personal guarantor, which can lead to problems later if you have a credit card or a line of credit that's under like a former board member's, name as a personal guarantee. It can be difficult to get them off of there, or God forbid you were previously in a director or the head of a board and you leave that organization. Have you thought about if your name is still left on there as a personal guarantee for those credits? What if the nonprofit goes under? Are you personally liable for that stuff? So I would say caution needs to be used there. If a bank is asking for a personal guarantee, I would recommend you look for banks that work with nonprofits. There's nonprofit specific banks or banks that cater to that kind of organization. And so look around. I mean, the article itself has a credit card ad at the ends, for a nonprofit based credit card application that you can put in. But I would say having that cash float is really important. And it's something that I don't think we've talked about enough on this program, but and then to properly use it, right? Only expend what you can pay back. You don't want to be propping up operations through lending because eventually, that will come true. I mean, I think anybody in the accounting realm has heard about, Enron and how they got upside down and were leveraged really hard. And so I think, making sure that you're leveraging the organization only enough that you can pay it back, but ensuring that you have some kind of cash float there that you can stem those times, when you've expended and you're waiting for reimbursement, or there's like a slow time in donation. Say your organization is seasonal, being able to weather, the off season to keep your organization running is vital. So I think it's a really good one. The other one that I would really harp on, and we've talked about before, is the operating reserve. How much operating reserve should you have? That's going to vary from nonprofit to nonprofit. And I think it depends on, we all know for the most part, most nonprofits' largest expenses is payroll. So how do you, reserve around a payroll driven expense cycle? Well, I think you need to look at what it would take to stem, a loss of funding for 3 to 6 months. And then you need to look at like the essential portions of your nonprofit to bring in more business, but more donations, more programs, if you were to lose funding in any one of your areas. So I think, it varies from, organization to organization. And I would look at kind of what your cash operating needs are. It's not looking at 12 months of expenses and dividing it by 12 and saying we need 3 to 6 months of that amount, because a lot of those expenses could go away if you lose funding or you lose a program that you're currently have. So I think it's a lot more nuanced than they kind of make it in the article, but realize, like putting your thumb on or putting your finger on how much reserve money you need is it can be a lengthy process, but I think it's worth it to understand how much money you need to stash away.
Yeah, AJ, one thing I just want to jump off of your earlier point that you made. It's pretty common in early startup nonprofits for board members or true believers to utilize some of their credit to help get things purchased, to help get things going. So like AJ was saying, be careful, especially you might not be there forever, but also get things in writing, right? Have a clear understanding with the nonprofit that you're doing this. This is especially going to help. Let's say you're using your credit card at the start to kind of purchase some basic items and that doesn't get paid back immediately. Well, are you going to cover the interest or is the nonprofit? Well, if the nonprofit's covering the interest, but it's the credit card's in your name, you better have some backup information, because then it starts to look like the nonprofit is paying you. So, just have awareness, go in with caution, get everything in writing, and, gradually start to build that credit for the nonprofit itself. AJ, I think you got our second article for us.
I do. So this comes our way of Philanthropy Daily, and it's guess what? Another article and another topic on cryptocurrency. So this one's kind of interesting because cryptocurrency users, the title of it is Cryptocurrency Users Are Creating Decentralized Autonomous Organizations, better known as DAOs, that function as nonprofits. Essentially what's happening is cryptocurrencies have created, million billionaires from mining crypto. And so they've created these decentralized autonomous organizations, and it's a kind of a new kind of group. And essentially it works much like any kind of foundation would, like you have an organizing board, and then, the holders of those coins decide, or the cryptocurrencies decide where it's going to be, and they enter into what's known as smart contracts, and they make decisions through online voting, and they weigh in, and they go through other forms of automation that kind of decide where the money's going to go. And so they're essentially like a crowdfunding club that then donates to, arts, all kinds of different philanthropy ideas. And so, it's a new kind of way that people are looking at it. But I think what nonprofits need to realize, if you're approached by one of these DAOs, that there's not a lot of regulation around it. Foundations, philanthropy foundations, private foundations, giving trusts and stuff like that have been around for years. And there's, mountains of documentation through the IRS on how those are run, how their money is, how the earnings on their money is, reported. They have to file for being tax exempt if they're a tax exempt trust or foundation. So, but there's not really that kind of law and history around these DAOs, as they're very, very new. So there's, the article goes into the legal questions regarding, like, if you're a nonprofit and you receive crypto and you keep it in the wallet, and there's gains and losses on that, and then does that put you in does that put your organization in a sticky situation? And it's unclear whether funds can legally flow through and to and out of a charitable one of these decentralized organizations, or is it a taxable kind of transaction, in which case it would kind of throw off the whole giving portion of this. So and it brings in state and national IRS and state charity offices into it, and how they monitor where those funds are coming from. For instance, if you're a 501c3, you're supposed to be receiving the majority, if not all, of your donations from U.S. domestic donors. And so what happens when you get an anonymous cryptocurrency donation, and somebody's trying to move money in India or something? Can you accept this and know that the donation is coming from a domestic partner? And that's not always clear in these. So it's something to think about when you're setting up your crypto donations. And we've talked about this before on the program, where if you're accepting donations, these crypto donations, you need to be getting the information on who the donor is, or at least attempting to be able to get that information. And so this brings up another kind of twist, I think, into these crypto donations that one that we haven't talked about before. And the other part of it is, I mentioned before, but you're talking about large swings in the crypto kind of market. And so we've always suggested on this program that you liquidate those much like a stock donation, so that you're not having the unrealized gains and losses on these things, or you're having to monitor these volatile markets to understand what the actual financial what the actual currency calculation is that you've been donated or that you're holding on to. So I think they either need to convert it into US dollars right away, or you're gambling with their future, essentially, value, by leaving them in one of these crypto wallets to just allow the market at play to decide what the value is from year to year. So anyway, I thought it was a really interesting article, brought up a few points I don't think we've discussed on the program before. But Mark, what did you think here? And, was there anything that stuck out to you maybe that we haven't talked about on the program before?
Yeah, I think you hit the high points here. And I think it's, it's tread lightly because we're in new territory. One of the pieces of this, because I'd never heard of these DAOs before, and one of the interesting pieces that, as a member of this DAO, you're owning a fractional percentage of the DAO. So depending on the fluctuation of the currency is how much you own, and then as you're giving this money away, you still own a fractional percentage of this DAO. So regulation hasn't caught up to these particular notions yet, right? Like with a foundation, there's a certain amount of cash. That cash is spent. That cash belongs to the nonprofit, and the nonprofit owns it, and the movement of money is clear. But if I'm a donor and I'm part of a DAO and cryptocurrency is going to a charity, I still have the same percentage of fractional ownership in that DAO. So is part of a donation by IRS law is that when donors make charitable contributions, they relinquish the money or asset they gave to charity. Did that happen here? And with crypto, it's kind of weird anyway, because everything is kind of tracked on the blockchain, and there's anonymity involved, et cetera. So these are all still questions that are being sussed out by minds much smarter than myself, frankly. But it is something to be aware of. You don't want to be in the position as a receiver of this money, receiving money in good faith and saying, great, a DAO has targeted us. And then, it turns around and all of a sudden that money, is not really a charitable donation from these people, and leaves you kind of like Homer Simpson saying, "Doubt."
Sorry. It's so true. I think it goes back to what we've said the entire time regarding stock donations or crypto. The best thing you can do for your nonprofit is to come up with a policy on how you're going to treat those coming in, if you're going to accept them, who you accept them from, and how you're going to, receive the information on who's donating it. And so, I think having a clear policy, and then what you do with the stock or crypto donation after you receive it, set your organization up for the best, to be in the best light if question about this stuff. And I think having a policy goes a long way on, making it clear for everybody in the organization on how these are handled. So, Mark, I think you got our next article for us.
You bet. This one comes to us from our friends over at the Stanford Innovation Group, and they have basically a simple sounding article called Fair Accounting, but the article is fairly dense. And basically, this is a revisiting of a topic that we discussed many, many months ago. You're going to have to troll through our archives, but basically, impact accounting is the topic at hand today. And so the idea, just to kind of bring you back to that, and this article summarizes that as well, is that there are companies, there are organizations looking at new ways of new proposals of ways of tracking a company's progress other than financial means. So how do we actually monetize impacts that, say, an oil company has on the environment, rather than just looking at how much money they're making for the bottom line? And so for so long, we've just been tracking profits and stock price, et cetera. And these are all based on simple financial metrics within a company. But the idea behind impact accounting is that it's converting some non-intuitive metrics from like a variety of different fields, whether they be like environmental science or public health, human resources, public policy, and trying to figure out a way to codify those, to give them some value, to say, this company is actually worth X amount of dollars, so that currency takes into effect all the other impacts that this organization is having. So you can see it gets very complicated very quickly, because how the heck do you monetize that? So when I'm looking at impact monetization, there are so many different factors one could bring in. It's almost infinite. Like, how is it affecting the public policy versus how it's affecting the environment versus how it's affecting children, whatever. You could just kind of sort of create these things out of whole cloth. And the thing with financial accounting is that you have $1 amount that you're looking at when you're comparing, say, two oil companies to one another. Whereas, if I'm comparing two car companies against one another, and I'm just looking at profitability, it's a lot easier than if I'm looking at an electric car company versus a traditional car company, to say, well, there should be some value on the other side on the environmental piece. And that involves metrics of coming up with what is good and bad, what we want to value, how heavily weighted these things are. And it seems like an impossible situation to solve, but there are smart, heady minds out there trying to come up with solutions. This article is kind of a response to the earlier article we're doing, that they don't particularly like the false narrative that they're binary between financial accounting and impact accounting, and you can either have one or the other. They're saying that there can be some metrics that you bring in. You can be converting some of these things to dollars and cents. I think it's difficult. You're never going to be able to get everyone to buy in and to get on board, but just because it's difficult doesn't mean we shouldn't allow for this. And for people who value this and who are looking for this, I think it's an extremely important topic for them, because they want to invest in companies that pay attention to these things. And frankly, it might make corporations better actors, because they're not just working for the bottom line stock price. They might be working for raising these metrics in other ways as well. So there's so much detail here, AJ, and we could have gone in 100 different directions, but I think I've laid it out, and let's just have a discussion as best we can here.
Sure. No, I think fair point, Mark. I think, this is a really heady, and it leads us down the path of like comparing like an economist's view to then like, and these guys are writing from an economist's view. And they try to dip their toes in what a financial accountant would take. And in fact, one of the things they say is, and they're talking about how to quantify like significant range across different areas. And we talked about like, for example, there's significant empirical research to support the convergence around a carbon price. Now, when I was in public accounting, we actually had a client that did these carbon offset tax credits. Essentially, it was like a brokerage house. If you were like a green kind of company, you could sell your excess carbon taxes or relinquish them to this holding thing. And then as a more pollutant organization, you could buy those tax credits so that the thought of it was, and this is an Obama era thing, was that these were to make the industries as a whole carbon neutral. Whereas if you were carbon positive and you had another one that was carbon negative, the buying and selling of these tax credits would, net out to be a zero, where one was actually capturing carbon, the other one was releasing carbon, and you sold these tax credits. So the thing was trying to value these darn things, and you had to rely on these actuarial reports to actually value each carbon tax credit that these people were horse trading around in this. But then they go to try and say financial accountants will find this range familiar as they think about the relative ease of accounting for internal payroll expenses versus tracking revenues from disparate income sources. Now, I don't know that you can make that comparison. Allocating payroll cost and where your income sources are coming from and allocating those in the accounting records is pretty straightforward and has been done for years and years and years. I think, kind of trying to shoehorn in carbon tax credits as analogous to allocating payroll is, quite frankly, I think a real reduction in what they're talking about. But I think what it does bring up is, I think this stuff is possible, but you're going to have to make concessions, and everybody's going to have to realize this is alternative to financial accounting. I don't think we can merge these two things and have a central, like, let's see your nonprofit's financial statement and understand the environmental impact by looking at this. This is going to be much akin, we talked about last week about your annual report. It's going to be much akin to an annual report or a sustainability report or any of these things that are already out there. Trying to quantify this stuff needs to be outside of the accounting records, because all it's going to be doing is putting this, for lack of a better word, woo-woo accounting in here, where you're trying to value something that I think is very difficult to quantify. And it's not like allocating payroll, and it's not like dispersing revenue into different programs. It is very much a finger in the wind calculation that's done by academics, I guess.
Yeah, and who's making those calculations, right, HA?
Exactly.
Right? Like, how do I and my auditors determine, we're good citizens, so we're going to give ourselves a minus, even though, we're polluting, whatever. And other organizations, who is there is no objective criteria. I'm with you on this. It's going to be super tricky to try to monetize that. Anyway, sorry, I interrupted, but go.
No, I think it's a good point, because hey, if by chance you're an actuarial listening to this, I think this is good for you, because I see this leading down an economist and an actuarial kind of path if they're going to go around this, more so than trying to codify it from an accounting perspective and debits and credits and understanding the valuation of this stuff from as an accountant, right? You're always trying to agree to supplemental information, and valuation is one of those supplemental information or third party, verification of pricing and stuff. You want a dollar amount, right? You can go through this thinking about like, you don't report volunteer hours on your financial statements unless it's an in-kind donation from a professional service. That's another bright line for in-kind services, right? You don't put a value to plant trees, but if you have a lawyer litigating for free that, something on your behalf, that's a professional service that you would book an in-kind donation for, right? And you have basis to be able to understand what that hourly rate or what their in-kind donation is. The same thing's true if you're talking about your environmental impact. You're going to have to look to a third-party source, and that's why I look to like the actuarials and the economists to be able to provide some kind of valuation on this. The same thing is done when we talk about if any of our nonprofits here have like what's known as level 3 investments in their investment hierarchy. A level 3 investment is there's no observable inputs and outputs, and there's not a market for it. So a lot of times, if you have like a REIT, it's a real estate investment. Those are level 3 investments. And when you're auditing or you're trying to value these things, all you're doing is trusting what the organized, I guess it's much like a hedge fund or something. You're believing what that hedge fund is telling you the value is, and then you're evaluating whether that REIT or that the organization that's actually valuing it is reliable. And that's the best you can do. And you make the assessment at that time, and then you move on. And I see the same thing happening with this impact accounting. If it's going to come to the nonprofit or for-profit sector, is you're going to have to be relying on some kind of expert and then evaluating how expert they are, I guess. And so I don't think you can squarely throw this back on the financial accountant's shoulders. In fact, I would pitch this back at the economists and actuarials to be able to understand the valuation on this.
Yeah, and I think just to kind of put a bow on this, first off, we're bringing this up on our nonprofit podcast, not only because it's an interesting accounting topic, but because, if this does come to pass, nonprofits are going to benefit from this, right? They're already doing a social good. And as a whole, nonprofits are out there serving society, and these woo-woo factors will work in your favor. But, I think I'm going to sort of come to the same conclusion I came to the last time we discussed impact accounting. It's a difficult proposition to undertake, but I'm really glad there are people out there thinking about this and undertaking it, because I think it is important. And the article wraps it up nicely. I'll just quote from them. By making decision makers accountable for their organization's externalities rather than just financial results, we move in the right direction. So I wholeheartedly agree. And let's just leave that there. And of course, we welcome your comments either on Twitter at ProfitlessPod or down in the notes here and on YouTube if you're watching it here. But yeah, we encourage you to join us in the conversation, because this is kind of feels like it's the future of what accounting can become.
Or if you're an actuarial or an economist and you want to come on and discuss how we're wrong.
Oh, yeah. We welcome that. Bring it. All right, AJ, you got our topic today.
Yeah, actually. So this is a question regarding membership dues and donations. So I'll read the question here. And what it is essentially somebody wants to know, they have like this Facebook membership that they're getting from their constituents, and people are donating. And they go into how Facebook is the best deal here, but essentially what they're saying is that they want to know if somebody essentially donates, they have a membership program, because I'm putting it in quotes here. We'll talk a little bit about the difference between a membership program and a donation here in a second. But they're saying they have this membership program where people essentially donate $7,500 via Facebook, and they're not really receiving anything for their money. And they want to know how this should be treated. Do they need to treat it as membership dues? And this is essentially either when we're talking about this, we're talking about the compliance in a 990 or an audit, and how that is reflected on your financial statements in those two arenas, whether it should be listed as a membership or a donation. And so I have my opinions on this, but Mark actually has more experience with this from his previous job. So I'll kind of let him weigh in on this. But there is a difference between memberships and donations, I think, that And I think it's good for our listeners to understand that, and especially this question that came in, understanding the difference between what a donation is, what's considered a donation, and what's considered a membership. So,
yeah, thanks, AJ. I think it's a pretty clear line here, right? So a membership is a membership if you're getting something out of value back from that. So as AJ alluded to, I used to work in a museum. And so we would sell memberships to that museum. And we, the organization, would value, your visits to the museum, we value at X number of dollars. Let's just say it's $10, just to make it easy. If you give a membership of $25, then you're paying over and above what the annual membership value is that you're getting. So your donation would be 15, and the actual membership piece of that would be 10. So you would only get a donation receipt for the amount over and above. This is very, very similar to how we've talked about fundraiser auctions, right? So you're only getting value, you're only getting a donation over and above what the value of that item is, assuming you're paying a premium for it. If you're not paying a premium, then you get no donation receipt for it. So, it's tricky for organizations who want to sound like they're, you're a member of our club, but they don't really offer anything that people outside of that organization are getting, or if they're just offering you camaraderie or one of these, like we talked about in the last article, something non-tangible that has value, but not necessarily something you can, take to the bank, right? It's not like a zoo membership where you get entrance or, any of these other membership things that you commonly hear about from nonprofits. So, and a donation is just whatever the amount is that you're paying over the base value of that. AJ, you got some more thoughts on that?
Yeah, absolutely. So I think the wording, like, this isn't a sticky situation as long as and I'll use like the $5, $100 word of, underlying economic substance of the transaction. So what that means is if you call it a membership and nobody is getting, any kind of other, it's just they're calling a membership. Now you're a member of our club, of our organization, but you're not getting anything in return for that. You're not getting a tote bag. You're not getting season tickets somewhere. You're not getting invited to their gala for free, anything like that. There's no quote unquote benefits for being a member other than you're donating and you're listed on their membership roster or whatever it is. Then that's a donation. And, I think it's good to take a step back and realize if you're offering one of these programs, you can call it a membership. You're not going to get in trouble for calling it a membership, but realize that if somebody is getting something back for their donation or their membership fee, then that would fall under the membership thing. Just like Mark said, if you're getting a tote bag or tickets, season, if you're a member of a theater group or something like that, and you're getting 5 free tickets a year to their plays or programs, then that is considered a membership. And the real reason behind it is, again, being able to know from the donor side what kind of letter they get and what's actually tax deductible. And it's no different than the auction discussion we had last week. And go back and listen to that if you're thinking about running a gala or an auction. But it's the same kind of rules apply. And I think it's this underlying concept of the donation or the tax deductibility of a donation is the money in minus any kind of benefit, financial benefit that they get, or the financial cost of anything that they get in return.
And make sure that organization is a nonprofit that you're becoming a member to if you want to get a donation, right? I can't get a membership to a gym and value that, and take a deduction on the excess value of what I get out of that, right? This is only working for categorized nonprofits. And it's tricky sometimes, right? Because some zoos might be for-profit ventures. You don't know just necessarily because you're buying a membership to the zoo that you're getting a nonprofit donation out of that. So,
yeah. And I think, like, you can call donations memberships. I think just being able to explain to somebody the economics behind what's happening in the background, like people give us $50, all they get in return is, like a letter saying you're a member. Well, that letter, it doesn't have any financial value to anybody. If we're talking about the article we just did, the social currency around it or the impact, maybe then an economist or one of these actuarials would assign a cost to it. But in our world of financial accounting and the codification behind all this stuff, there is no, economic substance to a letter saying now you're a member, but there would be if you get something in return. So I think taking a look at all of how your donations are coming in and understanding what's given back to the community or an individual that purchases one of these things, whether you call it a membership or not, or a donation, is relies on the fact that somebody is just freely giving their money and they feel good about it. And I have clients that call their donations memberships, yet they don't get anything in return. And on their financial statements, it's classified as a donation. So you're not going to get in trouble if you call your donations memberships or if you call your memberships donations, but realize that when you record them in the accounting system and you're returning the, essentially gift receipts or donation receipts to these people, that you're correctly reducing it by any kind of fair market value of stuff that they're getting in return. And please have a policy around this so nobody is stuck out, that's in your fundraising arm or development department or in the accounting department. They understand what to do and how these things are looked at in your organization. I think is, well, we probably sound like a broken record. It's job one. As long as you have a policy around it, I think that makes it clear to everybody, including the donors. Then I think everybody's happy, and it leads to a lot less questions and ambiguity when you're trying to put this stuff together.
All right. Thanks, AJ. With that, I think that brings us to a close of another episode of Profitless on Purpose. Easy for me to say. We really appreciate you joining us this week and delving into some accounting topics. We always welcome your questions. If you want to contribute to the conversation and want to throw in a question for our end of segment topic, or if you have any questions on any of the articles we did, we always love the feedback. Again, at Profitless Pod on Twitter, or just comment right below on our YouTube page. Again, on behalf of AJ and myself, thanks again, and we look forward to meeting with you next time to discuss more interesting nonprofit topics.
Thanks, everybody.